Considering the fact that sentiment tends to drive the markets as well as company fundamentals, there is that need for you to balance the two. You may be a fundamental investor. You may be making your decision based on pure core company fundamentals. Please, you don't neglect market sentiments, and so you will need to balance the two. You consider fundamentals, and at the same time, you don't neglect sentiments. You balance the two. And so in this video, I want to talk about how to successfully balance sentiments and fundamentals when it comes to investing. And so there are 10 strategies for balancing sentiments and fundamentals to achieve successful stock market investing. And so I want to look at these strategies one by one. Number one is prioritize fundamentals first. First of all, start with the fundamentals. That's the most important consideration when it comes to investing. So start with a solid understanding of a company's financial health, including earnings, revenue growth, debt levels, as well as some cash flow. Ensure the fundamentals align with your long-term investment goals before factoring in market sentiments. You consider the fundamental first. Does it really align with your expectation in the long run, in the long term? Then you now factor in, market sentiments. It's very important. Number two is use sentiment as a market timing tool. When you factor in sentiment, utilize sentiment as a market timing tool. So while fundamentals guide long-term value, the sentiment can help you time entry into the market and exit out of positions. If sentiments, is overly positive or negative, it may signal an overbought or oversold situation. If sentiment is kind of positive, people will go on a buying spree. That will then present an overbought situation. And if sentiment is kind of pessimistic and gloomy and discouraging, people will go on a selling they will embark on panic selling, and that would drive the entire market into an oversold situation. Number three is evaluate valuation metrics. You need to evaluate valuation metrics. You consider these metrics because they're very, very important in determining what to buy and what not to buy, what to sell, and what to hold on to. So combine sentiments with fundamental valuation ratios. Example, the PE ratio is very important. The price to book ratio is worth considering. And the EBITDA is also something you should consider. And so a stock with strong fundamentals but high valuation may be overhyped by market sentiments and vice versa. Sometimes the stock could be doing very well, but it might be overly expensive. It might be overly expensive. And generally, you don't make money when you sell. You make money when you buy. If you buy stock at a sufficiently cheaper rate, when you come to sell, when you come to sell that particular stock, you will make a higher profit than if you bought at an expensive price. Imagine buying a stock at maybe $10 and you sell at $20. You've kind of doubled your income. If you buy the same stock at $15 or $17 and sell at $20, you discover that you have a lesser profit. It's all a function of the price at which you buy. As by the time you evaluate all these metrics, it will determine whether the stock is overly expensive or whether it's still cheap for you to buy. Number 5 is stay disciplined during market cycles. The market always moves in cycles. All what is required of you as an investor is to remain disciplined. Just put on your blinders, like a horse. in a horse race and focus on your long-term objectives. Recognize that the market sentiments can lead to cyclical patterns, bull or bear markets. So stick to your fundamental analysis and avoid getting swept up in emotional decisions. Whether whether sentiment is overly bullish or bearish, don't be carried away. Focus essentially on fundamentals. That's the ultimate guide when it comes to successful stock investing. Please don't forget to uh, subscribe to this channel and like this video. Number 6 is leverage contrarian investing. You make use of contrarian investing. And so when sentiment is excessively positive, that's in times of bubbles, or negative in times of crashes, consider a contrarian approach. It takes discipline to not be influenced by heart mentality. If the heart is going this way, you take an opposite direction, dare to be different from most market participants. It will help you in the long run. As if the fundamentals are strong, market pessimism, may create buying opportunities and vice versa. And from time to time, although the crowd is right most of the times, but in a case where you feel the crowd is not right, in investing it's not a democracy where the majority is always right. Sometimes, the majority may be wrong. And if you dare to stand alone, maintain a contrarian stance, you will make an outsized profit in the markets. Number 7 is diversify your portfolio. Diversify your portfolio. And so balance your portfolio with a mix of growth stocks that's driven by sentiment and value stocks driven by pure fundamentals. This helps to manage volatility risk and especially during extreme market sentiment. So you create that balance in your portfolio when you diversify. Number 8 is review earnings season closely. Earning reports can shift sentiments dramatically. Look for discrepancies between market expectations and actual performance. Generally, people will tend to be so eager to see earning reports. Sometimes performance may deviate from expectation. So in that case, you see how you can benefit from it. If a stock is undervalued based on fundamentals but trading down due to market sentiment, it may present a buying opportunity. So try to look at the company's earning reports, and then you equally consider market sentiments, investor sentiments around that particular stocks. If it's favorable, you can go ahead and invest in that company. Number 10 is avoid emotional decision making. Recognize the psychological biases that influence sentiment, such as heart mentality and overreaction. The crowd is not always right, and don't follow them to overreact. Maintain a contrarian stance. So balancing sentiment with strong fundamentals help you avoid a kind of knee-jerk reaction and make rational long-term decisions. So by integrating both sentiments and fundamentals, you can make informed, well-rounded investment decisions that take advantage of both psychology and company performance. Don't forget the impact of psychology, the impact of human behavior when it comes to investing. It is quite critical, because most of the time, sometimes, prices are not only influenced by fundamentals, but they're equally influenced by market sentiments.